Welcome to the Deep Dive. Today we are strapping in to analyze the latest earnings call from Sunrun, ticker RUN. This is for their Q3 2025 results.
Yeah, and this call, it dropped after the cash close on November 6th. And what happened next was, well, a pretty stunning and swift market reaction.
A deep sell-off. And that's the paradox, because it happened despite some operational numbers that were, frankly, truly phenomenal.
You absolutely nailed the central tension there. This was a classic, mixed bag print, but the market only seemed to pick up the heavy item.
Right.
We saw a massive consensus-shattering beat on profitability, on cash generation, but all that good news was, well, it was utterly eclipsed by a single painful headline miss.
And so our mission today is to figure out that paradox. Why did the street ignore a beat of over 100% on EBITDA, and what's the real story that management is trying to tell you?
Let's start with the bad news then, the numbers that drove the panic.
Okay, so the key headline miss was GAAP diluted earnings per share. They reported 6 cents, that's 0.06, on net income of $16.6 million.
And that figure was, what, roughly a 50% miss compared to the street consensus?
Exactly. The street was looking for something closer to 12 cents. In this market, a 50% miss is just a massive red flag, no matter the context.
It is, yeah, especially when investors are so sensitive to, GAAP accounting transparency. But the context here is what's so startling. While that GAAP EPS number was weak, you have to look at their top-line performance.
Just incredible. Total revenue clocked in at a massive $724.6 million.
To put that in perspective for you, that blew past analyst consensus estimates of around, say, $601 million by about 21%.
And it's also a 35% increase year over year.
A revenue beat of that size usually gets you a victory lap.
For sure. And when you dive into the details, that revenue strength was fueled mostly by a 77% year-over-year surge in solar energy systems and product sales. That hit $233 million.
Right. And management did attribute some of that gain to a new asset monetization structure they introduced this quarter.
A detail we absolutely need to unpack later. It's crucial.
It is. But the real shocker for me was profitability. Adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization.
Yeah.
It came in at approximately $185 million.
Which is a very healthy 25.6% margin.
Analyst consensus was targeting only about $75 million.
Yes.
So you have a revenue beat of 21% and a profit beat of over 100%.
Okay, let's pause right here. This is the core of it. You have phenomenal underlying operational performance. You have these massive cash profit metrics, yet the stock drops 16% the following day. Why? Why does GAAP EPS, which is, it's complex, it's easily manipulated by non-cash charges, why does that completely override a huge EBITDA beat?
Well, it comes down to investor psychology, especially in a high interest rate environment like this. The market is demanding clean, simple, bottom line profitability, specifically GAAP earnings.
Generally accepted accounting principles.
Exactly. And when that number misses, and the company has to rely on non-GAAP metrics like adjusted EBITDA or, cash generation to tell its strength story, investors just assume the complexity is hiding something.
Hiding weakness or some kind of financial engineering.
Right. They want assurance that leverage and debt aren't masking core issues. The complexity creates doubt, and in that doubt, they sell.
That makes a lot of sense. So let's shift our focus to management's view. The story they want the market to focus on, the storage-first profitability thesis.
Absolutely. The CEO, Mary Powell, she was adamant that this was not just a one-off quarter. She really stressed that this was the 6th consecutive quarter of positive cash generation.
And they delivered $108 million in Q3 alone.
And for anyone who isn't familiar with Sunrun's preferred metrics, what exactly is cash generation in, plain English?
Think of it as the recurring, predictable money being created by the projects they install. But after you account for all the project costs, it's what really drives their business.
And they didn't just meet targets. They reiterated the midpoint of their full year 2025 guidance for cash generation at a strong $350 million.
And they narrowed the guidance range. That's always a key signal of confidence, right? It means they're pretty sure they can hit that middle ground.
The unit economics really reinforced that margin discipline, too.
They're clearly focusing on selling higher value systems. Upfront net subscriber value margins improved by 5 percentage points year over year. They're now standing at approximately 7%. And crucially, Contracted net value creation. That jumped 35% year over year to $279 million.
Which translates to $1.21 per basic share.
And this margin improvement, it's directly linked to their big push into home storage.
The pivot to storage first isn't a future goal anymore. It's the present reality. Their storage attachment rate, it reached a commanding 70%.
70%. That is up significantly from 60% just a year ago. That's a massive operational shift.
It is. They're building this huge fleet of decentralized power resources.
Exactly. They now have over 217,000 solar plus storage systems out there in their fleet.
And if you total up all that stored energy capacity, you are looking at approximately 3.7 gigawatt hours, or GWH, of network storage capacity.
That GWH number, that's what separates them from just being, a regular solar installation company. And management isn't shy about it.
Not at all. They actually accelerated their target for dispatchable capacity. They're now aiming for more than 10 GWH online by the end of 2028 or maybe early 2029.
Yeah.
That is a massive commitment.
It fundamentally changes the business model. They're positioning themselves as a decentralized distributed power plant operator.
And they're already seeing immediate value in this. Management stated that their prior estimate of, $2,000 or more in incremental net present value per home from grid services
Was likely conservative.
It's likely conservative. They already have 17 active grid services programs providing 416 megawatts of power capacity back to the grid. That's recurring, utility-grade, high-margin revenue.
Which brings us squarely to the segment that probably spooked investors and caused all this accounting friction. Let's do deep dive 2. Capital structure and complexity.
Right. This really centers on that new asset monetization structure they introduced in Q3. Up until now, they typically held the assets, the systems themselves, on their balance sheet. They'd recognize the value over time.
But in Q3, they started selling certain newly originated solar plus storage assets to a third-party energy investor.
But the key detail, and this is critical, is that they retain the customer relationship in all the future service revenue streams.
Right, so they sold the hardware and the immediate financing mechanism, but they kept the high-margin, long-term relationship with the customer.
Correct. And the financial impact was immediate. This change resulted in $115 million in revenue recognized during Q3.
And the CFO, he characterized this as primarily a GAAP presentation and timing change. He insisted the long-term cash generation profiles are basically the same as their old model.
But here's where the analyst scrutiny came in. Analysts on the call, they were aggressively pressing management on whether Q3 cash generation would have been weaker if they'd stuck to the old structure.
And that question, it just feeds the skepticism, the narrative that maybe the headline profitability is, opaque or reliant on these complex asset sales to look good.
And that skepticism is what drives the stock down. However, management insisted the new structure is complementary. It's not a replacement for their traditional financing.
They said they would have just used other traditional securitizations or debt draws otherwise.
Yeah, it's a timing friction. It's between the GAAP rules and how they actually monetize these very long-term assets.
And despite all this friction around complexity, their access to capital remains, remarkably strong. That's a huge differentiator in a high-rate environment.
It really is. They closed 3 Q3 securitizations. They raised $1.4 billion in senior non-recourse debt, which brings their year-to-date total to $2.8 billion.
So what do these securitizations tell us about the health of their assets?
They tell us that institutional investors still believe very strongly in the long-term, predictable cash flows that these residential systems generate.
For instance, their latest $510 million securitization priced at a 6.21% yield.
And when we talk about spreads, we mean the difference between that yield and a benchmark. That spread was only 240 basis points, or 2.4%.
Which demonstrates stable, predictable financing costs. The capital markets are clearly wide open for their paper.
And they also continue to prioritize balance sheet health. They reduced recourse debt by $17 million in Q3, bringing the year-to-date reduction to $66 million.
That's a critical focus.
It is. They're on target to reduce recourse debt by more than $100 million for the full year 2025. That shows disciplined use of their cash generation to delever.
They also grew unrestricted cash by $134 million year to date. So the balance sheet story, it's a healthy one.
So if the financial foundation is improving and the operational transition is accelerating, why is the stock still stuck in this negative narrative?
It comes back to the core strategic outlook, that volume versus margin debate.
Right. Management is explicitly prioritizing margin and these high-value, storage-attached customers over just chasing pure volume growth, especially heading into 2026.
They forecast volume for 2026 to be, I think the quote was flat to growing slightly,
Yeah.
reiterating that cash and margin are the focus.
And that strategy, it also serves as a pretty strong competitive defense.
How so?
Well, they expect to continue gaining market share even if the broader residential solar industry contracts. And that's because their subscription model, their TPO model, it's less exposed to the scheduled expiration of the Section 25D tax credit.
Right, compared to outright loan or cash purchase models. Sunrun owns the asset, so the consumer's tax credit situation is less relevant.
And management seems completely unfazed by competitive threats from these, new prepaid solar lease models.
They downplayed them heavily. They described them as niche, complex, especially when you try to scale that kind of financing model.
Yeah, management believes that new entrants will just struggle to raise the capital they need to compete with the massive funding platform Sunrun has already built.
So the core conflict is perfectly crystallized here. You have management telling Wall Street they are a cash-generating, storage-first energy infrastructure platform.
And that's backed by $185 million in EBITDA and a 70% storage attachment rate.
But the market narrative, which is driven by that headline sell-off, it focuses on levered growth with opaque accounting.
And that's all fueled by that EPS miss
Yeah.
and the complex asset monetization structure.
And that tension, where the operational story and the stock price diverge so dramatically, that's what creates the opportunity.
Which brings us to our high conviction segment.
This is not financial advice. We are operating as hedge fund analysts, and we're pitching a trade based purely on the technical market reaction and the fundamentals we saw in this earnings call.
Okay, the setup is clear. The current sentiment is deeply bearish. It's driven by the headline GAAP miss and the accounting complexity. The market has technically created a window of opportunity by punishing the stock far beyond what the underlying operational reality suggests.
So our outrageous but plausible idea is a long-dated, high-conviction long position. Given the massive, consensus-shattering adjusted EBITDA of $185 million, which is cash profit, and the acceleration of that 10 GWh network storage target to 2028, the market is fundamentally ignoring the shift.
The shift from solar installer to distributed power plant.
Exactly.
So to execute this trade, you would capitalize on the current overreaction and high volatility. We'd recommend leveraging options. For instance, selling near-term volatility, which is elevated after the sell-off.
And you use that premium you collect to buy longer-term call spreads, maybe targeting the 2026 or 2027 timeframe.
Right. This hedges you against any near-term GAAP turbulence, while you're banking on the strategic long-term execution.
And the thesis justification, it relies on three primary catalysts. First, the strategic shift to a decentralized power plant operator. It's demonstrably succeeding with that 70% attachment rate.
The second, the CFO specifically hinted that the securitization spreads, those 240 basis points, are currently about 50 basis points elevated relative to the general credit market.
So if those financing costs tighten by even 50 basis points, that immediately improves the present value and the internal rate of return on every single asset they install.
That's a massive tangible value catalyst, and it's being completely obscured by accounting noise.
And third, if they consistently hit or exceed that reiterated $350 million cash generation midpoint for the full year, the narrative just shifts entirely.
The market will be forced to re-rate them from a cyclical solar stock to a utility infrastructure stock.
And that catalyst will drive multiple expansion far beyond the current $21 to $22 average analyst target. This is a bet on strategic execution winning out over GAAP accounting confusion.
It is a bet that the cash flow is the only thing that matters in the long run.
So to recap, Q3 2025 for Sunrun was defined by a stunning divergence. Huge revenue and adjusted EBITDA beats, but the GAAP EPS miss, coupled with complex asset monetization, it drove a significant sell-off.
And the underlying story, it remains margin focus, strong financing access, and a leading position in residential storage with that 70% attachment rate.
Management is focused on long-term, predictable value creation through recurring energy services and building out their distributed power capacity.
They're transforming hardware into infrastructure.
Which leads us to our final provocative thought for you. Considering the immense, growing, and accelerating demand for electricity driven by factors like AI computing, the explosion of data centers, does Sunrun's existing 3.7 GWh of networked battery capacity make it less of a simple residential solar company and more of a decentralized vital energy infrastructure play for the entire North American grid?
If you look at where the future capacity needs to come from, those 3.7 GWh and the goal of 10 GWh, they start to look like critical assets, not just residential appliances.
Thank you for joining us on this deep dive into the Sunrun Q3 2025 earnings call. Go forth and continue exploring this knowledge.